Futures down a bit this morning, but of course we've got plenty to work with after a huge rally the last 6 months. It seems to be turning a little bit more speculative. Got unprofitable companies bouncing. The Russell trying to break out. Of course, crypto's going nuts. Joining us, Sam Burns, the chief strategist at Mill Street Research and founder. Sam, welcome back to the Schwab Network. Thanks for being here.
Hi, Oliver. Thanks for having me on again.
Okay, so what started that was kind of a more sound and justified earnings-driven recovery of all this AI stuff seems to be turning into a more frothy kind of FOMO-style stock market and general risk asset market. What do you make of it?
Yeah, you're right. I think it's been shifting more to sort of the high optimism kind of an environment after a long stretch of basically investors, I think, kind of fighting this and being too negative relative to what the underlying fundamentals were. So I think the risk now is not that the fundamentals are bad or are going to get worse necessarily, but that everyone kind of is realizing it and are starting to bid things up a little bit more than they used to. So it could go on a little while longer. Like you said, FOMO is a powerful force. It can keep things going for a while. But I think we're getting into that, sort of stage of this particular rally where we're going to get more of the froth starting to come in, and then we might get a correction maybe mid-year.
Okay. I mean, the thing is, there's no obvious real threat imminent, it seems. Data in the economy has been so resilient. Employment really just has not broken, even though we've seen pockets of firings and layoffs. They seem to be made up elsewhere, and the overall figures haven't turned downward. Some of our bad leading economic indicators have turned around. So there's a lot that seems strong from the economic standpoint. What about the inflation front? Is there risk that that's a threat? Yields have been climbing, but the stock market hasn't cared.
Yeah, I think the general backdrop is still one of kind of disinflation. I think there's going to be a lot of noise still, and January was a good example of that, where you had some potential distortions in the data. But I think the overall trend is going to be lower. I think the underlying pressures on inflation are relatively muted. And you can see that like bank credit growth, people aren't taking on a lot of more debt. There's not a lot of excess bank credit being created. Commodity prices are still falling. There's still been a downtrend for 2 years now. That's usually a good leading indicator. Most of the rest of the world is also seeing inflation starting to come down as well. So it's not just in the US and how we measure things. So I think there's still some lags in the data from shelter and things like that. And I think there's still going to be, noises, particularly around year end, January. But I think the general trend will be lower, and I think that's the reason why I think the stock market is less concerned about it, because I don't think the Fed will be back in play again in terms of raising rates for a long time. I think that the next move will be a cut, but it'll just be a little while longer.
What gives you confidence the general trend for inflation will be lower? We have heard from some folks like Jamie Dimon who have argued that we're in new regime, that the floor for inflation should be higher from here, that some of our tailwinds structurally have faded a bit. What do you make of that?
Yeah, I mean, there's always the possibility that things turn, but I think the general idea is that, like I say, in addition to things like commodities going down and relieving the pressure on kind of goods. We see core good prices for goods for the most part actually at zero or negative inflation rates. It's only services that are still going up, and a lot of that is still the shelter component. So I think once you've adjusted for that, inflation is already fairly close to the 2% target that that the Fed looks for. So I think it would take some effort to reverse that and push it up, absent a new supply shock. I think a lot of what we saw the last few years was more due to supply shocks than demand shocks, or excess demand. I think with rates where they are being quite tight relative to inflation, and with the underlying pressures abating in terms of supply shocks, unless we get a new supply shock of some kind, I think the trend is to go back down closer to that 2% level that was typical pre-COVID, and which I think is still supportable even if you have reasonably solid employment growth and income growth. Income growth by itself doesn't create inflation. It's only when supply falls below the income growth that really becomes a problem. But lately, supply has been growing along with demand. And I think that's why you could have reasonable growth and still low inflation.
How should investors be thinking about the timeline for Fed cuts as a catalyst for the market? How much does it matter? What type of stocks does it matter to? We went from pricing in almost 7 at one point this year, now to maybe 3 like max. But again, it doesn't seem to have been a problem, that repricing.
Yeah, you're right. And that's been a thing for the bond market for, a year or two now, where they get too aggressive and expecting rate cuts and price in too much, and then have to be forced to back off when the Fed pushes back or the data holds up. So I think that's more of a problem for the bond market, and that's why I've been underweight bonds, is that they're priced. They had been priced a lot of times for more aggressive rate cuts than are likely to happen, and then have to, adjust, and that causes a lot of volatility and not much return. I think stocks have kind of, are benefiting from the strong economy, which bonds, of course, don't, and have learned to kind of look through some of that short-term wobbles in the projection of Fed rate cuts. In my view, it's really the direction that matters rather than the timing. The fact that the next move by the Fed is likely to be a cut, and there may be more than one this year, is really what matters to stock prices and stock investors. That there's going to be a downward move rather than upward move, and the fact that the economy and the earnings have been able to hold up with higher rates already, so that any relief there would be a benefit. I think it would be a most benefit to small caps rather than large caps. Large caps, because most of them don't need to borrow money and have a lot of cash on their balance sheet, actually benefit from these higher rates in terms of earning money on their cash balances. And so I think it's the smaller companies, the ones that need to raise financing and that don't have as much access to capital, that'll benefit from that when it happens. So I think there's going to be, maybe you have to wait a little while longer to get sustained small cap outperformance. Small caps can still go up, and they have. It's just a matter of whether they'll outperform the large caps. May have to wait until you actually see the rate cuts come through.
Yeah, that's why some of the strength of the last week here in the Russell is particularly notable to me, because at the same time you've gotten curve flattening because the 2-year keeps moving higher, like we're going to push those cuts back even more. Thinking about that subject a little bit more here, Sam, when we look at the Fed's ability to cut, what kind of information do you think we need to see from inflation, as you talk about what matters to markets being the fact that we're not going to hike versus cut? What if they don't cut? What if they just stay? Well, what is the impact if we're neutral?
Yeah, I think there's a possibility that they hold for longer than people think, and that's what the bond market's kind of adjusting to. I think once the sort of the core PCE year-over-year number that kind of is the main focus of the Fed gets down close to 2%, it's going to be harder for them to argue that we need rates at nearly 5.5%. That's going to be a really high real rate for them to be able to justify. But I think even if they did keep rates there, or maybe they only cut once or twice, I think that would still be okay for the stock market and the economy. And really, the mid-late 1990s is kind of the example of when that happened. There were only, I think, 3 cuts, small cut, 3/4 point cuts in 95, 96, and you still had a roaring stock market, roaring earnings, and falling inflation that whole 95, 96, 97, 98 period. So that's kind of the example I think people may be starting to look at more, is that kind of late 90s soft landing scenario where you had good economic growth, falling inflation. You didn't really have many rate cuts. Bond yields were higher then than they are now, and you still had a really strong market because productivity growth was strong, and that allowed strong growth without inflation. And so we may be, if we're lucky, starting to see that this year.
Okay. Sam, good conversation. Appreciate the discussion. Nice macro framework for us as we prepare for inflation tomorrow. Thank you very much.
Thanks.
Sam Burns, founder and chief strategist at Mill Street Research.